lot of people are worried about their bank these days. While devastated giants like Citigroup get bailed out again and again and again, many smaller banks are failing. The federal agency that takes over unsound banks is the Federal Deposit Insurance Corporation, the same people who guarantee that depositors won't lose their money. Most every Friday now, the FDIC is seizing several banks. You haven't seen these takeovers happening because they're done secretly at night to make sure that there's no needless panic by depositors. But last week, we were given extraordinary access to one of these operations because the FDIC wants you to see what happens to your money when your bank has failed.
They're going to start at one branch, pull the cash out, take it inside the bank.
This is a team of FDIC agents preparing to seize a bank outside Chicago.
What we need to do is we need to pull the corporate records.
They've checked into this hotel under a fictitious name, CB and Associates. To prevent a run on the bank, they don't want anyone to know who they are or why they're here.
You all know that this is for the closing of Heritage Community Bank.
Cheryl Bates and Arthur Cook are in charge of the operation that has been given the code name Happy. Strange, considering what they're about to do.
Do not discuss outside of this room what is going on, what we're here for.
They're here to seize all 5 branches of Heritage Community Bank, a 40-year-old local bank providing savings, student loans, mortgages, and checking. But like so many others recently, Heritage made ruinous bets on real estate. Sheila Baer is chairman of the FDIC.
How many banks failed last year?
25.
How many do you expect to fail this year?
It's going up. There have been 16 already now, and so our loss projections are going up. We're having to increase premiums on banks to address the loss projections going forward. It's a very distressed environment right now.
I wonder if you have a number in mind of how much the FDIC is prepared to pay for bank failures in 2009.
Well, we make a 5-year projection that for the next 5 years we project that we'll lose $65 billion on bank closings.
$65 billion?
$65 billion.
Some of that was about to be spent on the imminent failure of Heritage Community Bank. It held 12,000 deposits totaling more than $200 million. The FDIC team waited for the last customer to leave. Cheryl Bates prepared to go in.
What sorts of specialists do you have on this team?
We have accountants, we have asset specialists who specialize in loans, we have people who specialize in just the physical facilities, and we have a group of investigators that come in and do a review on the reasons for the bank failure.
Really, your whole team could come in and run the bank?
Yes.
4 months ago, the FDIC in state of Illinois ordered the bank to stop risky lending and raise cash, but Heritage couldn't find new investors. The night of February 27th, no one at the bank knew that the end was minutes away. The FDIC walked into all 5 branches at once. The chief executive, John Saphir, was told that the bank that was his life's work was no longer his. We waited outside as they delivered the news to the employees.
With Heritage Bank, your pay stopped at 6 p.m. At 6:01, you went on a pay which is paid by the FDIC. Unused vacation time, you will be paid for it. You will not lose it.
In that moment, Operation Happy looked pretty grim.
Correct, because I would say a large majority of the employees don't know that the bank is in trouble and that it's about to close.
We want it to be as seamless as possible for your depositors, so no depositor loses any money at all. And they reacted somewhat with dismay and shock that we were there. And it is a very trying period for them. So it is an end to that whole chapter of their lives.
When we walk in, we appear to be the bad guys.
I mean, some of those people have been there more than 20 years.
And those are the ones who take it the hardest because they feel that they have put their life into it and now it's no longer there.
Make sure that no one comes in without FDIC badges.
The employees now work for the FDIC. A public notice went up, and that was the signal to a team of nearly 80 people to take over the bank. They took control of the bank website and added a notice that all deposits were safe. Then they started an inventory of all the assets and liabilities.
What's happening right now?
We're getting the bank personnel assigned with their FDIC counterparts. The accounting people are meeting with our accounting managers, and then we have an investigations group that comes in and does a review of the bank.
They broke the news to the media and prepared to reopen the bank Saturday morning, as usual.
What do you expect from the customers?
I think the customers some of them will come in with a sense of fear.
Fear created the FDIC in 1933, after the Depression set off panics that wiped out even healthy banks.
We've been around for 75 years. Nobody's ever lost a penny of insured deposits.
No depositor has ever lost a penny
no,
since the FDIC went into business.
That's right, of insured deposits. That's absolutely right, which is why you need to make sure you're below the insured deposit limits, but no one's ever lost a penny.
And the insured deposit limit is what?
Right now it's $250,000. That's the base limit.
When the FDIC comes in and makes depositors whole at a bank that has failed,
Right.
Is that tax money?
No, it is money from our reserves, and we are funded by insurance premiums that are assessed on banks. So no, it is not taxpayer money.
FDIC Chairman Sheila Bair is a former Treasury official and professor of finance who's written children's books on the wisdom of saving.
Maybe some of the CEOs on Wall Street should have read the children's books.
Maybe so. Maybe so.
Bair warned 2 years ago that bad mortgages threatened the financial system. Now she's managing the biggest bank failures in years, including the collapse of Washington Mutual and last summer's sudden failure of IndyMac in California.
We were told we would get in.
Stay open an extra hour.
When IndyMac failed, you were watching these scenes on television
Yes, I
of people
was,
lining
yes.
up outside the bank like it was 1932.
Yes, it was. It was
What did you
amazing.
think of that?
So I think people just forgot that banks do fail and how the FDIC works. Their money was safe. It was safe. It was probably the safest place in the world to have your money because we were operating the institution at that point.
What sort of hit was that on your balance sheet?
I think we ended up it was over $9 billion for a $33 billion. Yes, it was very stiff.
The question becomes, how many times can the FDIC do that? At what point is the FDIC broke?
The FDIC is backed by the full faith and credit of the United States government. So if we need to, we try not to and don't want to, but if we need to, we can borrow from Treasury to make up for any shortfall.
So the FDIC never goes broke?
We don't go broke. No, we are the government. We're backed by the full faith and credit of the United States government.
But customers at the former Heritage Community Bank outside Chicago weren't so sure about the safety of their money. On Saturday morning, the bank reopened on time, and the FDIC's Ricky McCullough stood at the front door. The people who were coming in this morning, what were they asking you?
Can I still write checks? Can I access my safe deposit box? Can I use my ATM machine?
And to all of those questions, you answered what?
Yes.
Customer Bill Hess showed up on a mission with an empty briefcase. He intended to leave with all of his money.
We'd be glad to answer any questions for you.
I don't care anymore.
He said, "I don't care anymore."
And so I became a little concerned. So I came inside. And one of the things that he told me as he opened up his briefcase, he said, well, I don't have a gun in here. So I said, well, that's good. I can't wait.
McCullough explained to Hess and his wife Audrey that their savings were safe.
So if you have a single account, that's $250. If you have a single account, that's $250. So now that's $500.
Hess's briefcase was empty when he came in and empty when he came out.
We just thought we were going to see closed and the doors locked.
Yeah.
You know.
So how do you feel now that you've talked to them?
It's fine.
Assured.
Yeah.
Assured. Yes.
You feel
fine.
assured?
Yes. Yes.
You had confidence in the FDIC.
FDIC, right, yeah. Now, if they can't pay you, then I won't have confidence in them either.
One customer did take most of her money out, but for many, their concern was for the bank employees.
I hope you all stay, and I hope they don't let anybody go.
We're fine.
Good.
You just keep coming back to see us.
There are three ways the FDIC takes over a bank. It can close it and pay off depositors, run the bank itself, or more often, it'll try to find a buyer.
We do have bids from 5 different parties.
A few days before the takeover of Heritage Community Bank, we were at the FDIC office in Dallas, where they were holding a secret online auction in hopes of finding a buyer for Heritage.
I wanted to congratulate you. We've chosen to accept one of your 3 bids.
The winner was MB Financial, a $9 billion Chicago bank.
The night of the takeover, all of Heritage Community's branches became MB banks. Mitchell Feiger is MB's CEO. It's almost as if nothing had happened.
Almost nothing did happen. It's the same products, it's the same services, it's the same people taking care of the same customers.
It was a sweet deal for Feiger. The FDIC paid MB Financial $3.5 million. MB got all of the deposits, customers, and loans. If some of those loans go bad in the future, the FDIC will pick up at least 80% of the losses. We wondered what Feiger thinks of the health of banking today.
You have to believe that dozens and dozens and dozens of more banks have to fail. But it's okay.
What do you mean it's okay?
It's okay because I think the process is smooth. Depositors are fully protected by an industry-funded FDIC insurance. And I think that taking out the weak players and taking some capacity out of the industry is good. It's good for the industry. It's good for the survivors. It will produce at the end a much healthier banking system.
If you can put Heritage Community Bank out of its misery, why can't you do the same with Citigroup?
First of all, I don't talk about open and operating institutions. We can only deal with the resolution of a bank, a federally chartered or state chartered depository institution. And these very large institutions that are creating the headlines now, these are really very large financial organizations. So it's more than a bank, it's a broker-dealer. It's offshore operations, it's foreign deposits.
We notice that while giant banks get bailed out, investors in failed community banks like Heritage get wiped out. Ben Bernanke, the chairman of the Federal Reserve, says that the system is unfair for smaller banks, and that's just the way it is.
Well, I think that's true. And going forward, I think we need to really review the size of these institutions and whether we should do something about that.
Bear surprised us when she suggested that maybe the mega banks, those bailed out by the taxpayers, shouldn't be allowed to exist in the future.
I think that may be something Congress needs to think about.
Actually limit how big a bank can be.
Yeah. Well, I think taxpayers rightfully should ask that if an institution has become so large that there is no alternative except for the taxpayers to provide support, should we allow so many institutions to exceed that kind of threshold?
And the idea would be that no bank would grow so large that it posed a systemic risk to the economy. That'd be a very different world.
It would be a different world.
Because Heritage Community Bank was bought by MB Financial, the FDIC didn't have to pay depositors. Even accounts over the insurance limit were safe. For Cheryl Bates, it was her fourth closing this year, but certainly not her last. What do you want people to think when you tell them you're from the FDIC?
I always want them to think that I'm one of the good guys and that we want to make sure that they get their money back. Should their bank fail, that they are going to be okay because the FDIC is there.
On September 15, 2008, Lehman Brothers, the fourth largest investment bank in the world, declared bankruptcy, sparking chaos in the financial markets and nearly bringing down the global economy. It was the largest bankruptcy in history, larger than General Motors, Washington Mutual, Enron, and WorldCom combined. The Federal Bankruptcy Court appointed Anton Valukas, a prominent Chicago lawyer and former United States attorney, to conduct an investigation to determine what happened. Included in the 9-volume, 2,200-page report was the finding that there was enough evidence for a prosecutor to bring a case against top Lehman officials and one of the nation's top accounting firms for misleading government regulators and investors. That was 2 years ago, and there have been no prosecutions. Anton Valukas has never given an interview about his report until now.
This is the largest bankruptcy in the world. What were the effects?
The effects were the financial disaster that we are living our way through right now.
And who got hurt?
Everybody got hurt. The entire economy has suffered from the fall of Lehman Brothers.
So the whole world?
Yes, the whole world.
When Lehman Brothers collapsed, 26,000 employees lost their jobs and millions of investors lost all or almost all of their money, triggering a chain reaction that produced the worst financial crisis and economic downturn in 70 years. Anton Valukas' job was to provide the bankruptcy court with accurate, reliable information that the judges could use to resolve the claims of creditors picking over Lehman's corpse.
Had you ever done anything like this before?
I've never done anything like Lehman Brothers, and I don't think anybody else has ever done anything like Lehman Brothers.
So your job, I mean, in some ways, your job was to assess blame.
Our job is to determine what actually happened. Put the cards face up on the table and let everybody see what the facts truly are.
Valukas' team spent a year and a half interviewing hundreds of former employees and pouring over 34 million documents. They told of how Lehman bought up huge amounts of real estate that it couldn't unload when the market went south, how it had borrowed $44 for every one it had in the bank to finance the deals, and how Lehman executives manipulated balance sheets and financial reports when investors began losing confidence and competitors closed in.
Did these quarterly reports represent to investors a fair, accurate picture of the company's financial condition?
In our opinion, they did not.
I mean, isn't that against the law?
It certainly, in our opinion, was against civil law, if you will. There were colorable claims that this was a fraud, yes.
By colorable claims, Valukas means there is sufficient evidence for the Justice Department or the Securities and Exchange Commission to bring charges against top Lehman executives, including CEO Richard Fuld, for overseeing and certifying misleading financial statements, and against Lehman's accountant, Ernst & Young, for failing to challenge Lehman's numbers.
They'd fudge the numbers. They would move what turned out to be approximately $50 billion of assets from the United States to the United Kingdom just before they printed their financial statements. And a week or so after the financial statements had been distributed to the public, that $50 billion would reappear here in the United States, back on the books in the United States.
In the next financial statement, they would move it overseas again and file their report and then move it back.
Right.
It sounds like a shell game.
It was a shell game. It was a gimmick.
Lehman misused an accounting trick called Repo 105 to temporarily remove the $50 billion from its ledgers to make it look as though it was reducing its dependency on borrowed money and was drawing down its debt. Lehman never told investors or regulators about it.
This is really deception to make the company look healthier than it was.
Yes.
Deliberate?
Yes.
How are you so sure of that?
Because we read the emails in which we observed people saying that they were doing it. We interviewed the witnesses who wrote those emails, or some of those emails, and asked them why they were doing it, and they told us they were doing it for purposes of affecting the numbers.
Do you think Lehman executives knew that this was wrong?
For some of them, certainly. There were concerns being expressed at high levels about whether this is appropriate, what happens if the street finds out about it. So, there was a concern that there's a real question about whether we can do this, whether this was right or not.
One of those people was Matthew Lee, who had been a senior executive at Lehman and the accountant responsible for its global balance sheet. Lee was one of the first to raise objections inside Lehman about the accounting trick known as Repo 105.
It sounded like a rat poison, Repo 105, when I first heard it. So I investigated what it was, and I didn't like what I saw.
Was there a point in which you saw the accounting principles employed by Lehman Brothers change?
November 30th, 2007 was the end of our fiscal year, and I fully expected us, to make a loss that year, like everyone else. And when I saw we made money, it was a record year, in fact, I thought, that doesn't sound right. You knew the markets were doing badly, so why wasn't Lehman doing badly? And every time I found something and I went to my boss or whoever, no response.
That was 10 months before Lehman Brothers went bankrupt. Lee's position required him to sign off on the accuracy of the firm's accounting practices every quarter. But in November of 2007, he declined to do it.
By refusing to sign it, you were saying that you didn't believe the numbers.
Correct.
That this wasn't a fair and accurate representation of the financial condition of Lehman Brothers.
Right. Something's up here. Why can't people answer my questions? Why has Repo 105 doubled? Give me an answer. Nothing was said.
Lee continued to press people for more information, but nothing changed. And 4 months before Lehman collapsed, he sent this letter to Lehman's top executives.
I've been telling you all year, I've been banging my head against the wall. I'm now putting it in writing.
Says it requires me to bring to the attention of management conduct and actions on the part of the firm that I consider to be possibly unethical and unlawful.
Yeah.
What were you talking about specifically?
Well, in that particular letter, it was general. There were so many specifics. I could have written laundry lists.
What kind of a response did you get from this letter?
It was like throwing a grenade. I wanted to wake somebody up, at least to address the topics.
It worked. 6 days after he sent that letter, Matthew Lee was downsized, let go after 14 years. But Lehman executives couldn't ignore the letter and asked their accountants from Ernst & Young to interview Matthew Lee.
And in those interviews, we have the notes, which are part of the report. He says very specifically, $50 billion repo transactions moving money off the balance sheet at quarter end. So our conclusion was Ernst & Young certainly knew it as of that time and did nothing with it.
Valukas says Ernst & Young was legally bound to make sure that Lehman's audit committee and its board of directors knew about Lee's allegations of unethical and unlawful accounting practices, but they never did.
Did the audit committee know?
No.
Did the board of directors know?
No.
Did Dick Fuld know?
Did Dick Fuld know? Well, he says no.
The only place Lehman CEO Richard Fuld has publicly answered questions about his firm's bankruptcy has been in front of Congress.
I have absolutely no recollection whatsoever of hearing anything about or seeing documents related to Repo 105 transactions while I was the CEO of Lehman.
He said the same thing to me face to face.
Do you believe him?
There was evidence which would show that that's not accurate. The president of Lehman Brothers told us that, in fact, he had conversations with Dick Fuld about this, and documents were shared with him which would reflect the Repo 105 transactions and how they were being used. Richard Fuld's view on that was that he has no knowledge of it. You have other evidence that he did. A jury would have to decide who's telling the truth.
But so far, there's been no jury to hear the evidence.
Despite Valukas' findings and the supporting documents and testimony to back them up, the Securities and Exchange Commission has not brought any charges of any kind against former Lehman executives. For the past few months, we've made numerous requests to interview the SEC's head of enforcement. All of those requests have been declined. The Securities and Exchange Commission has not brought a case?
No, they have not.
Does that bother you?
I'm not permitted to be bothered by that. My job was to set out the facts, lay it out. They have to make their own prosecutive decisions.
There is one plausible explanation why the SEC hasn't gone after top Lehman executives. As it turns out, some of Lehman's most egregious accounting shenanigans took place right under the noses of government regulators.
How closely was the SEC monitoring Lehman Brothers during this time?
They were on premises. They were talking to the Lehman people daily. They officed there.
It was not widely known at the time, but during the last 6 months of Lehman's existence, teams of officials from the SEC and the Federal Reserve took up residence inside the firm to monitor its precarious financial situation. They were inside the building when Matthew Lee wrote his letter to Lehman executives alleging unlawful accounting practices, and they were there when the practices took place. Valukas says the SEC also knew that Lehman was being less than truthful when it said that it had enough assets to survive the crisis. But that and other damaging information was never disclosed to investors, who continued to pump billions of dollars into the firm.
Should it have been disclosed?
Absolutely.
Isn't the government, the SEC in this case, the people who are supposed to protect the investors?
Yes.
Aren't they charged with informing investors?
Yes.
Why didn't they do it?
They may not have had the expertise necessary to understand the material they were receiving. They were getting the material. Whether they understood it is another question.
The very fact that government regulators were inside the company with access to its books and records would complicate any prosecution of Lehman officials. Until 4 months ago, David Kotz was the SEC's Inspector General. Over the previous 4 years, he'd issued more than 100 reports about major deficiencies in the way the SEC did its job.
If the SEC knew about some of these problems at Lehman Brothers and they weren't disclosed, doesn't it make it difficult for the SEC Enforcement Division to come back and bring action against Lehman Brothers? They were there, they saw it.
Yeah, I think that that's definitely an impediment to a potential case. And certainly if you go before a jury, the defense lawyers can make a big point about the fact that you were there, you knew about it, why didn't you do anything at the time? Now you're coming after them.
In fact, former Lehman CEO Richard Fuld seemed to be trying out that defense when he testified before Congress in 2008.
Throughout 2008 The SEC and the Federal Reserve conducted regular and at times daily oversight of our business and our balance sheet. They saw what we saw in real time.
Let's just assume for a moment that Anton Valukas' findings are true. I mean, isn't this just a free ticket for executives to say, well, look, Lehman did so-and-so and nothing happened to them?
Right. No, I think absolutely that's a serious problem. I mean, obviously, there has been a tremendous financial crisis. The people who engaged in improper behavior need to be punished. I think it's critical for the SEC to go after not just companies, but also individuals where they have the evidence to do so.
When Lehman's bankruptcy was finally settled, there were claims against it for $370 billion. The creditors settled for about 20 cents on the dollar. Former CEO Richard Fuld now runs a consulting business in Manhattan. He lost most of his fortune and is embroiled in a raft of litigation, but is still a wealthy man. Most of his senior colleagues at Lehman have landed on their feet. Ernst & Young, Lehman's accounting firm, is now being sued by New York State for aiding and abetting a fraud. And Matthew Lee, the senior accountant who blew the whistle at Lehman, is still looking for work, unconvinced that much has changed in the world of finance over the last 4 years.
The entrepreneurs of Wall Street are continually getting more and more sophisticated, and they don't necessarily want regulators or auditors to fully understand what they're doing.
Do you believe the balance sheets of big Wall Street firms if you read them now?
These numbers are so big and the financial instruments are so complex that, nobody stands a chance really of understanding. I'd have more fun investing in crap tables in Las Vegas than Wall Street firms.
Banks are supposed to lend money, and when they stop, as they have in recent months, the workings of our entire economy are threatened. Credit became so frozen, the government had to step in this past week and take an ownership stake in the country's biggest banks. On Monday, Treasury Secretary Henry Paulson summoned the CEOs of the 9 largest banks to Washington and gave them a massive amount of money so that they would start lending again. The largest of the banks is Bank of America, now partly owned by the United States of America. The head of Bank of America is Ken Lewis. He says when he and the others met at the Treasury Department, it became clear that Secretary Paulson's offer was an ultimatum. No negotiation was allowed.
No negotiations, no.
So in other words, take it or take it.
Right, right.
One of those.
Right.
It's said that he told the bankers and you, this is your patriotic duty.
I don't remember if he used the word, but there was an element to that this was the right thing for the American financial system, and therefore it was the right thing for America.
Did you feel that? Was that a persuasive line of argument?
Absolutely. I deeply believe that. I think he was right on.
Now explain why it was so important to the government that everybody agree, that the 9 largest banks are all in this.
If you have a bank in that group that really needed the capital, you don't want to expose that bank.
In other words, stigmatize it,
right.
so everybody
Exactly.
knows
right.
that they're not as good as somebody
Exactly.
else. Most of you were just stunned by the amount of money that the government put on the table.
Yeah,
yeah.
At least I was, and I think most everybody else was.
The total was $125 billion of taxpayers' money. Bank of America, Lewis says, didn't need the money, but got $25 billion anyway. Do you have any choice in this? In other words, can you take the money and not lend?
We wouldn't want to do it that way because you can make more money lending. And so the intent will be to use it to grow loans and to make more net income.
But under the Treasury plan, there's no requirement that a bank use the money to lend. It could use it to acquire weaker competitors or put it in Treasury bills. One of the few strings Paulson attached relates to salaries. A bank would have to pay more taxes if it paid an executive over $500,000 a year. One of the bankers in the meeting objected and started arguing with Paulson, and that's when Ken Lewis, a critic of excessive executive compensation, spoke up.
I did make the point that we needed to stop talking about executive comp and get on with this because that should not stop the deal.
Actually, you're quoted as saying, if this is what's going to stop this, you're out of your mind.
I did use the phrase "out of your mind."
Because why? Because you thought if it got out publicly that...
Know that the importance of this deal getting done versus these elements of executive comp were just out of sync. I mean, this was so much more important, and all of us can take a little less money.
With his salary and lucrative stock and options, Lewis took home $25 million last year. But he's one of the few in the business who can be fired without a golden parachute. And he thinks executives on Wall Street have made too much money.
I think they were overpaid. It's more egregious in financial services than any other industry that I know of. We need to cut back compensation in this industry.
So this is a question everybody wants answered. Is this socialism? Have we now sort of taken a huge step away from the kind of freewheeling capitalism that we've known for the last 30 or so years?
I don't know what we'll call it, but it will be different, and there will be more regulation. The golden era of financial services is over, in my opinion.
But why isn't it socialism? If the government starts owning our banks,
and that will not last forever. We will pay off the preferred stock at some point and come back to not being owned partially by the government.
Can you give us what your sense of how long it's going to take?
Yeah, I think somewhere between 3 and 5 years we'll pay it off, and then you go back to more toward capitalism.
It's said that one of the main reasons the bank is doing well is because of your decision not to get into subprime mortgages.
In 2001, my first year as CEO, we decided that we just didn't like the business. It was too risky, and so we decided to get out of it.
He makes it sound like a routine decision, but getting out of most of the financial products that brought Wall Street crashing down was significant. And now Lewis runs one of the country's healthiest banks, which just keeps growing.
We saw the strongest growth in deposits in the third quarter we've ever seen in our history.
He told us that during this crisis, people are taking their money out of other banks and putting it in his.
We bank every other American family, in America.
You what?
We bank every other American family in the United States.
No.
Yeah.
Half of the American families
does business with us in some form or fashion.
You mean credit cards, auto loans, deposits?
Checking accounts, exactly. Right.
Half the country. Mm-hmm. The way B of A accomplished this was by buying the #1 company in virtually every category of banking. For instance, it bought Countrywide in mortgages and MBNA in credit cards. Now it's a nearly $3 trillion conglomerate, the Walmart of banking. This is the iconic image of Wall Street, 600 wheeler dealers buying and selling. But this is B of A's trading floor, and it's 600 miles south of New York. The biggest bank in America is headquartered in Charlotte. Some people don't even know what state Charlotte's in, whether it's North or South Carolina. Am I insulting you?
No, in fact, I always say Charlotte, North Carolina, just so that I don't have to ask the question.
You have this building, this building,
that building,
that building.
Then there's one next to us, that building.
Not surprisingly, B of A seems to own Charlotte, and the town grew with the bank. Hugh McCall was the bank's CEO before Lewis. Now, it started out as a relatively small regional bank.
Well, we didn't like being small. I mean, there's nothing really attractive about being small.
He set out to expand the bank's reach from coast to coast and make Charlotte a financial powerhouse.
I think we have this sort of southern underdog of wanting to be masters of our own fate and not be dependent on northern capital.
When you were growing and you'd go to New York, did they not treat you well? Did they treat you like sort of the country bumpkins? And
I guess when I was a young man, I always felt a little uncomfortable in New York.
This uncomfortable feeling that they weren't respecting you. Did you have it in your head, I'm going to conquer New York?
Well, that would overstate New York. I was more interested in America.
Did you really think that you could overtake Wall Street?
Well, have you ever played tennis? It's once you size up the competition and decide whether you can beat them or not, hey.
And you thought you could?
I thought I could.
And they did. The crowning victory came last month when Wall Street's most famous investment houses were collapsing under the weight of their toxic portfolios and needed rescuing. They went hat in hand to Charlotte, North Carolina. Everybody thought you were going to buy Lehman Brothers. Friday night, that was the buzz. Monday morning,
Right.
it's not Lehman Brothers, it's Merrill Lynch. What happened between Friday night and Monday morning?
I had talked to Secretary Paulson that Friday and basically said we didn't think we could do the deal without government assistance.
With Lehman?
With Lehman, that we couldn't do it without some help. And then about 10:30, John Thane called.
It was Saturday morning, September 13th. John Thane, the CEO of Merrill Lynch, was on the line. Lehman was on its deathbed. Merrill Lynch was said to be next. You always wanted Merrill Lynch.
We've always thought that was the best fit
You were
for us.
drooling for Merrill Lynch.
We have always thought it was, yeah.
Deals of this magnitude take months of due diligence and vetting. This deal was thrown together over a weekend, with Bank of America spending $50 billion to buy one of Wall Street's emblematic companies. But now B of A is exposed to Merrill Lynch's poisonous investments and continuing losses. The question is, did Ken Lewis pay too much?
Some think that we should have waited till Monday and see if they would have gone bankrupt.
You're saying that if you'd waited, they might have gone bankrupt.
Some think we would have gotten it for dirt cheap. But my point is, you would have had a tarnished brand, you'd have had chaos, you would have had a court ruling over all of the sale of assets, and that it was worth it to us to pay a more market price so that we could not have that happen. So what about Merrill's 17,000 brokers? Lewis has said their salaries are too high. Is New York going to lose a lot of jobs, do you think? I don't think a lot. I mean, obviously we've got $7 billion of cost savings to get, and so that means that there will be jobs eliminated. $7 billion? $7 billion in cost savings. Oh my God. So the government's rescue isn't helping everyone on Wall Street. What about Main Street? Has the lending started? Did this jumpstart lending again? It should. It's only been a few days, obviously, and it will make a big difference. It will. We're sitting down with you Wednesday. Mm-hmm. The market is, at this moment, going down again. The market's going down, and what's worrying me is the fact that we've gotten the financial system in much, much better shape, but the economy is still a question mark, and we are in a recession by any standard other than maybe some technical standard. It feels like a recession, and we think it's going to take some time before it gets better. Bank of America is the largest mortgage lender in the country. Right. So when do you think the housing problems are going to bottom out? Our best guess now is that toward the end of the first half of next year, we'll start to see either signs of bottoming or the actual bottoming. What about credit card debt? Is that going to be the next shoe to drop? It, in some ways, already is, because credit card losses have risen pretty substantially. Credit card debt and auto loan defaults are part of why the bank's third quarter earnings dropped nearly 70%. Lewis called the situation a damn disaster. Do you think your job is secure? I've not. I must think that, because I don't think about that question. It doesn't enter your mind. No. I threw you a zinger, didn't I? You did. Yeah. Did you defeat Wall Street? No, to some degree we're part of it. So I don't know that we defeated it, but. Well, if you're number one. Right. And if the idea was to compete with New York or Wall Street, you won. We have won in that sense.
When it comes to bailouts of American business, Barney Frank and the Congress may be just getting started. Nearly $2 trillion tax dollars have been shoveled into the hole that Wall Street dug, and people wonder, where's the bottom? It turns out the abyss is deeper than most people think, because there is a second mortgage shock heading for the economy. In the executive suites of Wall Street and Washington, you're beginning to hear alarm about a new wave of mortgages with strange names that are about to become all too familiar. If you thought subprimes were insanely reckless, wait till you hear what's coming.
What's the future hold? Well, this shows...
One of the best guides to the danger ahead is Whitney Tilson. He's an investment fund manager who's made such a name for himself recently that these investors, who manage about $10 billion, gathered to hear him last week. Tilson saw a year ago that subprime mortgages were just the start.
We had the greatest asset bubble in history, and now that bubble is bursting. The single biggest piece of the bubble is the U.S. mortgage market, and we're probably about halfway through the unwinding and bursting of that bubble.
Halfway?
It may seem like all the carnage out there, we must be almost finished, but there's still a lot of pain to come in terms of write-downs and losses that have yet to be recognized.
In 2007, Tilson teamed up with Amherst Securities, an investment firm that specializes in mortgages. Amherst had done some financial detective work, analyzing the millions of mortgages that were bundled into those mortgage-backed securities that Wall Street was peddling. It found that the subprimes, loans to the least creditworthy borrowers, were defaulting. But Amherst also ran the numbers on what were supposed to be higher quality mortgages.
And they were frankly terrifying as data we'd never seen before, and that's what made us realize, holy cow, things are going to be much worse than anyone anticipates.
The trouble now is that the insanity didn't end with the subprimes. There were two other kinds of exotic mortgages that became popular, called Alt-A's and Option Arms. The Option Arms, in particular, lured borrowers in with ultra-low initial interest rates, called teaser rates, sometimes as low as 1%. But after 2, 3, or 5 years, those rates reset. They went up, and so did the monthly payment. So a mortgage of, say, $800 a month could easily jump to $1,500.
Now the Alt-A and Option Arm loans made back in the heyday are starting to reset, causing the mortgage payments to go up and homeowners to default.
The defaults right now are incredibly high at unprecedented levels, and there's no evidence that the default rate is tapering off. Those defaults almost inevitably are leading to foreclosures and homes being auctioned and home prices continuing to fall.
What you seem to be saying is that there is a very predictable time bomb effect here.
Exactly. I mean, you can look back at what was written in 05 and 07, you can look at the reset dates, you can look at the current default rates, and it's really very clear and predictable what's going to happen here.
Just look at this projection from the investment bank of Credit Suisse. These are the billions of dollars in subprime mortgages that reset last year and this year. Now look at what hasn't hit yet. The Alt-A and Option Arm resets when homeowners will pay higher interest rates in the next 3 years. We're at the beginning of a second wave.
How big is the potential damage from the Alt-A's compared to what we just saw in the subprimes?
Well, the subprime was approaching $1 trillion. The Alt-A is about $1 trillion. And then you have Option Arms on top of that. That's probably another $500 to $600 billion on top of that.
How many of these Option Arms would you imagine are going to fail?
Well north of 50%. My gut would be 70% of these Option Arms will default.
How do you know that?
We know it based on current default rates, and this is before the reset. So people are defaulting even on the little 3% teaser interest-only rates they're being asked to pay today.
That second wave is coming ashore at a place you might call the Repo Riviera, Miami-Dade County. Oscar Munoz used to sell real estate. Now his company clears out foreclosed homes.
Business is just going through the roof for us. Fortunately for us, unfortunately for the poor families who are going through this.
I wonder, do you ever come to houses where the people are still here?
Absolutely. That's really a sad situation. I'd rather not meet the people.
Why not?
It's not easy to come in and move a family out. It's just our job to do it for the bank. It's just the nature of what's going on in the market right now.
What is going on in the market right now? How much work are you getting?
Every day we have 20, 30 assignments.
A day?
A day.
Just your company?
Just our company. And we're one of the few companies right now who are hiring. We have to hire people because the demand is so high.
People who've been evicted tend to leave stuff behind. The next house is usually much smaller. Banks hire Munoz to move the possessions out where, by law, they remain for 24 hours. Often the neighbors pick through the remains. Once the homes are empty, the hard part starts, trying to find buyers in a free-fall market. Miami real estate broker Peter Zalewski talks like a man with a lot of real estate to move.
We have 110,000 properties for sale in South Florida today, 55,000 foreclosures, 19,000 bank-owned properties, 68% of the available inventory is in some form of distress. They need someone to clean it up.
What's the name of your company?
It's called Condo Vultures Realty.
What does that mean?
That in times of distress, in times of downturn, there's opportunity. And vultures are clean up the mess. A lot of people seem to think they kill, but they don't actually kill, they clean.
The killing in Miami was done by the developers back when it seemed that the party would never end. They sold hyper-inflated condos at what amounted to real estate orgies, sales parties for invited guests who were armed with option arm and Alt-A loans.
There were red ropes outside. They had hired cameramen and they had hired photographers to almost set the scene of a paparazzi.
They were hiring fake paparazzi to make the customers feel like they were special.
You were selling a lifestyle.
What role did these exotic mortgages play, these Alt-A's and the option arms?
They were essential. They were necessary. Without the Alt-A or option arm mortgage, this boom never would have occurred.
It never would have occurred because without the Alt-A's and the option arms, many buyers never would have qualified for a loan. The banks and the brokers were getting their money up front in fees, so the more they wrote, the more they made.
They stopped checking whether the income was even real. They turned to low and no doc loans, so-called liar's loans, and jokingly referred to as ninja loans. No income, no job, no assets, and they were still willing to lend.
But help me out here. How does that make sense for the lender? It would seem to be reckless in the extreme.
It was, but the key assumption underlying the willingness to do this was that home prices would keep going up forever. And in fact, home prices nationwide had never declined since the Great Depression.
On the way up, everyone wanted in. No one expected to feel any pain. People like acupuncturist Rula Giosmas became real estate speculators.
How many properties did you buy in this last 5-year period?
I believe in the last 5-year period I bought about 6 properties.
And what did you buy them for?
For investments.
She says she put 20% down on each. Now they're all financed with option arm loans.
What did you understand about the loans?
Well, unfortunately, I didn't ask too many questions. I mean, in the old days, I would shop around, but because of the frenzy, and I was so busy looking to buy other properties, I didn't really focus on shopping around for mortgage brokers.
But if you're investing in real estate, you're buying multiple properties, you should be asking a lot of questions.
Yeah.
Why didn't you ask?
I was busy. I was really busy looking at property all the time, all day long.
Did you read the paperwork?
No, I didn't.
Now she's losing money on every property.
You know that there are people watching this interview who are saying, you know, she was just foolish. She was greedy and foolish. She was buying small apartment buildings and wasn't paying enough attention to how they were financed.
My full-time job is I'm an acupuncturist, so this was just a side thing.
You're an acupuncturist, but you got stuck in real estate.
Yeah.
Giosmas says she was misled and she hopes to renegotiate her loans. But many other buyers have simply walked away from their properties. This Miami luxury building was a sellout, but when we visited, a quarter of the condos were in foreclosure.
What did this place go for?
This was originally purchased in October of 2006 for $2.4 million.
$2.4 million? What's it worth now?
The asking price from the lender is $939.
So it lost $1.5 million in value in a couple of years?
It was a tough 2 years.
And there are tough years to come, because just like the subprimes, the Alt-A and option arm mortgages were bundled into Wall Street securities and sold to investors.
In a nutshell, 2009 looks like what to you?
Miserable.
2010?
Miserable, even worse.
Sean Egan runs a credit rating firm that analyzes corporate debt. Fortune magazine cited Egan as one of 6 Wall Street pros who predicted the fall of the financial giants.
This next wave of defaults, which everyone agrees is inevitably going to happen, how central is that to what happens to the rest of the economy?
It's core. It's core because housing is such an important part. We're not going to get the housing industry back on track until we clear out this garbage that's in there.
That hasn't cleared out yet.
In fact,
we haven't seen the bottom.
It's getting worse.
What do you mean?
There are some statistics from the National Association of Realtors, and they track the supply of housing units on the market, and that's grown from 2.2 million units about 3 years ago up to 4.5 million units earlier this year. So you have the massive supply out there of units that need to be sold.
Well, with the housing supply increasing that much, what does it mean?
it means that this problem, the economic difficulties, are not going to be resolved in a short period of time. It's not going to take 6 months, it's not going to take 12 months. We're looking at probably about 3, 4, or 5 years before this overhang, the supply overhang, is worked through.
In the next 4 years, 8 million American families are expected to lose their homes. But even after the residential meltdown, Whitney Tilson says blows to the financial system will keep coming.
The same craziness that occurred in the mortgage market occurred in the commercial real estate market, and that's taking a little longer to show, but there are going to be big losses there. Credit cards, auto loans, you name it. So we're maybe halfway through the mortgage bubble, but we may only be in the third inning of the overall bursting of this asset bubble.
Does that mean that the stock market is going to continue plunging as we've seen the last several months?
Actually, we're the most bullish we've been in 10 years of managing money, and the reason is because the stock market, for the first time, I can say this in years, has finally figured out how bad things are going to be, and the stock market is forward-looking. And with U.S. stocks down nearly 50% from their highs, we're actually finding bargains galore. We think corporate America is on sale.
The stock market will still have a lot of figuring to do, with more troubling news on the horizon. The Mortgage Bankers Association says 1 out of 10 Americans is now behind on their mortgage. That's the most since they started keeping records in 1979.